You see, today's topic for our discussion is monetary policy, which is under the supervision of RBI, Reserve Bank of India, the central bank. This policy is there in place to ensure that sufficient amount of liquidity is there in market. The monetary policy deals with money supply in your local market. So the policy which deals with money supply is called as monetary policy, being reviewed on bi-monthly basis. And every 2 months, review committee will be sitting and will be ensuring that whatever condition you have in your market, like if there is any special need to bring in any special intervention, so RBI will be doing accordingly. If there is excess liquidity or something, they will try to extract. If there is scarcity, they'll try to inject extra funds into market. So just to bring things in order so that your GDP and your overall economy can grow faster at a better rate. So if you look, the role of RBI is mainly to take care for economic development of country. Here you need to have stability. Economic stability means inflation is well in check. uh, Economic growth is only possible when you have adequate amount of loan generation, and then you have credit delivery mechanism is in place. Smooth facilitation of loans is done, so that you see the more and more investments are made into economy, it will lead to better productivity, it lead to a higher level of a higher level of employments, followed by higher amount of per capita income, which improves ultimately the consumption pattern of the entire country. And you see, the another role of Reserve Bank of India is to ensure the interest rate is very competitive and is at par with various other global markets. So they will try to ensure rates are in line to local market condition, and then you see, and competition is kept in mind. uh, Next is like developmental financial institutions are there. So, I'll name some of them: National Housing Bank, NABARD, SIDB. So you see, they all are apex bodies for different sectors. So these financial institutions, so what they do is like they take care for a particular sector in total. So their role is to act as a officiating member from RBI, and then coordinating with different commercial banks so as to ensure equitable growth in all these sectors. And then you see, finally, it is the backward areas. So regional rural development is what they want. Like equitable development opportunities should be there. Now, if you look into this slide, you'll find that it is your reserve requirement which is actually taken into consideration. So the common rates which are very widely into discussion is like CRR, which is cash reserve ratio, currently at 4.5%. MSF, any marginal standing facility rate is 6.25. Base rate is somewhere in a range of 8.65 to 9.40. MCLR, overnight marginal cost of lending rate, is in the range of 7.5 to 8.5. Saving deposit rate ranges between 2.7 to 3. Term deposit rate, which is greater than 1 year, so is in the range of 6 to 7.25%. Call money rates, especially for money market where interbank lending and borrowing is happening, is 4.8 to 6.47. And this is like you see, it depends on market condition according to the liquidity available. Then you have capital market where you have indices called as Sensex and Nifty, which are being traded at 59,806 and 17,589. So these are some these are some benchmark points which are very important to understand your economic condition. So, like you see, if you go by monetary policy, you'll understand money supply in your economy may sometimes go up as compared to the requirement, or sometimes it go low as compared to what is actually expected. So you see, both situations are dangerous. When you have excess, it will lead to excess liquidity. Inflation will be very high. On the other side, if you don't have liquidity available, you see, maybe people don't have opportunity available, so they may again lose something. So extremes are always not good. So they'll have to ensure it that if it is excess, you have to extract. If it is short, then you have to inject. So it is done by these two techniques that we have. One is quantitative and second one is qualitative. Quantitative measures are those measures which, when being used, it will affect all banks at same point of time with same amount of gravity. Okay, so let's say a rate change. Let's say CRR is increased from 4.5 to 5.5. Just 1% hike will be there for all the banks, irrespective of your background, maybe public sector or private sector. Okay, so if it has to be a general impact on everyone, it is supposed to be a quantitative technique. And if it is supposed to be individualistic, yani customized as per the institution, so it is qualitative in nature. So quantitative measures include CRR, SLR, open market operation, and bank rate, whereas qualitative measures include direct action, moral persuasion, then you have credit rationing. Okay, so these points will come into place. So let's go into bank rate. Bank rate is the rate which is actually charged by central bank on loans and advances to control money supply in the economy. Okay, so bank rate is actually effectively, if you see, there is no application of bank rate except for the reason like for discounting of bills. So you see, this is the rate which is used for a reference rate. Okay, it is usually computed on quarterly basis, looking into the inflation, and like you see, this helps banks to understand what sort of like trigger points are there as it impacts every sector of a country. A change in bank rate affects customer as it influences prime interest rates for personal loans. Check. The present bank rate is 6.75. Uh, Followed by, you see, let's go to the next area, which is like repo rate. Repo rate is again the rate for which, like you see, again, Reserve Bank of India is going to charge it to different commercial banks when you borrow it from RBI. Okay, when banks are supposed to borrow it from central bank, they have to pay a rate. This rate is called as repo rate. This is for overnight basis. Like you see, you buy it today and you have to like return the money overnight basis, means next day. When repo rate increases, what is the effect of this is like your borrowing cost for your money that you're raising it from RBI goes up, and it makes your borrowing cost heavy, means your loan rates will further have a higher side impact. Any customers are supposed to pay for more. When repo rate you see goes down, it will have a reverse effect. Yani you see, customers borrowing capacity will be increased, they will be motivated. Okay, so this is how it has to be done. So present repo rate is around 6.5%. So 6.5% is also called as, you see, in terms of basis points, 1% is equals to 100 basis points. Reverse repo is the rate at which bank park their funds with RBI. You see, if RBI would like to take money from different banks in order to reduce the liquidity. So you see, this is what is called as reverse repo rate. The rate presently is 3.35. You see, when it is bank borrowing it from RBI, 6.5. When it is RBI taking funds from bank, it is 3.35. You can see the variation. Okay. So next is statutory liquidity ratio. SLR is actually nothing but it is in the is a ratio of total like total funds that you have in the form of deposit. So you keep a percentage of it in the form of investment. So it is invested in approved securities. These approved securities are defined by RBI. So it is helping you see monetary policy in a manner, like you see, if we have excess liquidity, what we can do is like we can increase the amount of SLR. So it will help RBI to reduce the amount of liquidity available with banks for loaning purpose. Okay, now you see, next is like currently SLR, statutory liquidity reserve, is somewhere at 18%. It can be kept in the form of cash, gold, government securities, or any other investment form. Okay, excess of CRR balance against what is like the requirement value is like is can be considered under SLR obligations. So qualitative measure. Now you see, qualitative measures are bank specific, one to one. So first is your marginal requirement. Marginal requirement means what amount of margin are you supposed to take when it is supposed to be a loan. So you see, if you increase the amount of margin, then taking a loan will be tough. Taking a loan from a bank will be tough. But if you reduce it, you see, it is going to be a motivation, and people will be able to borrow with that very low amount of margin. Let's say for purchasing a bike, we are expecting only 5,000 rupee for every lakh. So you see, it is actually an inclination where people will come forward. But if you say 50% is like what they are going to finance and 50% is what you have to bring it from your own pocket, the strategy may demotivate many. Okay, so marginal requirement, whenever it is increased, is the demotivation, and then people will not be able to take loans. Rationing of credit means you set a limit for a particular sector. If that limit is exceeds, you see RBI will automatically put a ceiling, and then no further loaning can be allowed into that sector. You see, this is again a sort of qualitative measure. Then next is like you have moral persuasion, where you request, you have your various means of advertising, and you try to get it done. Then direct action is like where you see certain banks are not following the instruction of RBI even after repeated reminders, if they don't change their practices. Like in past, if you see, ICICI Bank initially was blamed for issuing credit cards to anyone in market, and then it actually affected the people's behavior, any consumers behavior. So every bank was under a compulsion to give it, because ICICI Bank was doing it. So RBI has pointed it out for ICICI Bank, and then they have restricted ICICI from giving any further credit card loans. So you see, this is what has been done in past, which is actually an example of direct action. So moral persuasion is where you give consultation, counseling. Okay, your target is like you should be able to stop the wrong practice by giving counseling, and if it is possibly avoided using counseling method, which is very like sometimes it is not giving you the desired result, so you can go for it. Now these are the various quantitative and qualitative measures which RBI do have it in their kitty to bring things in control. Hope you understood. Thank you.